Hi, everyone. On this week's Tuesday Night Live, we had Alyssa Glutz back. She is author of Color My Credit, and you guys really let her have it. You let her know exactly how you felt, and she got a little upset. But again, when you're a podcaster, this is what comes with the territory. But we were very thankful to have her back on. What did you think, Todd?
I think you have to have thick skin to podcast. What can I say? But, I get it, right? I understand why people were not buying it. Alyssa, we love her. She's great. But she was saying in our last video that we did with her that rates would get down to 4% in the first quarter. And I think a lot of people remember her saying that. I said, no way. I think rates are on the rise. But she's a great person. I'm sure, she's fine today. But yeah, it was rough, man. They hammered her.
Absolutely. So quite a lot of you were giving your thoughts on your current situations, where you are right now, how you feel about the market. We had one viewer made a comment, can't afford to buy now with sky-high mortgage rates and home prices not falling. We also had another viewer made a comment, you are the only person who can speak the truth. I make $170,000 a year. I have $600,000 to put down. I can't find anything in New York.
Prices have come down, Melissa, from where they were a year ago, but not in every market. As we know, we spoke about it in some of our past videos. There are some markets that have even gone up 10, 12, 15% over last year's prices, which seems insane to me, but the buyers just won't allow it to cool down in some of these markets where the job growth is strong. But I think, Melissa, it's coming. I still believe we are going to see a major adjustment. People have to remember that the peak happened in 2006 in the 2008 crash. So in end of 2006 into 2007, we started to see prices come down after the media started covering the overpriced housing market. But it wasn't until 2008 before we really saw the blood in the streets, the results of the foreclosures and things like that. So I think, regardless of whether we see another '08 or whether it's worse or not as bad, I still think it's the tip of the iceberg.
Mm-hmm. Alyssa brought up people that probably won't be moving because of the low interest rate that they got in the past 2 years. But we had a viewer made a very good comment here. Why is everyone so stuck on the rate? I feel the problem is the home price. If you are at 2% and you overpaid by $150,000, how long are you in negative equity?
And I want to talk about the equity because, Alyssa also said, and we'll get to that question, but along with what you were saying, Alyssa said that not only do people have very low interest rates that have purchased, I guess, prior to last year, but their house prices were escalating for the last several years. So even though they got a great rate last year, and maybe they were in 4% or less, they still overpaid for the house. And, that's the problem. And as far as the people that, over the last couple of decades, really with rates going down below 7%, right? Historically, they've been averaging about 7.7%. But over the last couple of decades, we've seen it under 6% or 6% or less. And then certainly over the last probably decade, the majority of the mortgages were at 4% or somewhere around there. The problem, Melissa, and Alyssa said this, that people would be fine because they have tons of equity in the house. The problem is that isn't necessarily true because most people have extracted the equity out of their house. A lot of them have gotten second mortgages, HELOCs, home equity lines of credit, so that they could do improvements, and especially over the pandemic when they were just getting work done at the house. So now their equity for a lot of people is gone. And they've taken that house all the way back up to where they have little wiggle room. And as we start to see the economy unfold, as I think it will, and I'm not an economist, but many economists are saying we are far from over, and that some people are even calling it a depression coming, or a major recession. I think that a lot of these people are going to realize they don't have the equity, and you need about 10% equity from what you owe to, what your house is really worth in today's market in order to sell it and not come out of pocket. Now, for the question, yes, people are focusing on the rate, right? They're saying, hey, like date the rate. Don't worry about the price of the home. If you can afford the monthly payment, you can refinance it. I think this is probably the biggest disservice that many are telling their buyers right now. And that's because, if we look back in history at 7.7% as an average 30-year fixed rate mortgage, I don't think we're going back to 4%, Melissa. I don't think that we're going back from much of where we are right now. And what people really need to realize is that there's expenses to refinancing. You have appraisal fees, you have loan origination fees. I mean, it's not a slam dunk. It's expensive. And, to get your payment, I mean, just for a quarter of a point or a half a point, it's not really worth it unless you're planning on living in the house for a very long time. And I think this is what a lot of loan officers don't want to admit, and maybe what a lot of real estate agents don't want to admit either. And, getting back to your comment of the viewer saying that they feel that we try and bring the truth here on the channel, that even goes at a cost of, kind of upsetting some of our industry peers, right? Because they're like, why are you telling people this? Guys, it's time that we educate the public. This isn't just about selling a house, though. Yes, that's how I make my living. But, people need to know really what's up. And I feel it's time, and people are smart enough to get it straight.
Mm-hmm. We talk about the commercial market, the vacancies, where things are going. We had a viewer ask a question about how that's actually going to relate to the residential housing market. So here's the question. We've heard a lot in the news as of late about a commercial real estate bubble popping. Do you think that is in our future? And if so, how would that affect the residential market?
So I don't look at the commercial real estate industry as a bubble, not like housing, right? Because one of the things that kind of keeps the lid on the commercial industry is that people need a profit in order for it to make sense. But I do see a commercial real estate collapse in a lot of different markets. I think that people are now, we could break that down even further. We can talk about the residential commercial market, which would be big multifamily housing, right? Apartment complexes, things like that. I think they're going to see some major adjustments to their bottom line. One of it is that rents are coming down. Jay Powell has made it clear they're going to see that rental inflation is capped, right? They say that's the only thing that's still out of control. In the last FOMC meeting, Powell said that he is starting to see where rents are coming down with the new leases. We are starting to see rental companies giving discounts for 14-month rentals, holding price increases, things like that, trying to attract the tenants. But I think we're going to have a glut of that product. And, but I think the biggest crash we're going to see in the commercial market is that commercial tenants are struggling right now, especially in the retail sector, the restaurant sector. And these are a lot of the anchors. Restaurants are anchors for a lot of these shopping centers. And what happens is it's a term in commercial real estate. It's called going dark. And what happens is essentially like the lights are going off, right? So a tenant starts to go out of business and there's a vacancy. And then all of a sudden, they put paper on the windows, they put their lease signs up, and then another one goes down and another one goes down. And these spaces aren't filled quickly. And what happens is that really starts to affect the community that surrounds that. So yes, commercial does affect residential in a lot of ways. Even if they're not really big employers, it brings in a lot of sort of negative kind of stigma to a community when its shopping centers are going vacant. It's something we've seen before. It's not good. It takes a while sometimes to fill these vacancies. And, and it just makes the other tenants struggle. In commercial real estate, they position businesses, good operators, and good management companies or commercial real estate, they position businesses to help each other, to cross sell. So they want, a customer for one to leave their door and go in another door. And I think, once that starts to go down the tubes, rents start to decline, tenants start to struggle more. Bad news. Not only that, but I think we're going to see some major upheaval as to the refinancing that will take place, and the credit is tightening, and these banks just aren't going to want to refi these commercial notes with their balance sheets, their profits and loss statements waning and declining.
Speaking of businesses, we had a viewer made a comment about the future of AI. They said just on BBC, AI to replace 300 million jobs. What are your thoughts on that, Todd?
Hey, we're seeing Chat GPT all over the place. In fact, I was hoping to go to a conference in Florida that was talking about this AI app, especially the new generation of it that is pretty accurate. And, I couldn't go, but, I think we're going to see more of this. It is threatening our jobs. I think a lot of people, depending on what industry you're in, if you're in marketing and advertising, you are a writer, I think it could be potentially devastating to these businesses and these types of jobs. But we'll see. I mean, right now we've seen where the AI is getting better, but it's still not perfect. We've seen that with some of the online real estate companies that are aggregating the data from the MLS, and it's kind of picking up weird things. We're selling a concrete house, and it said that it was wood construction. It said that the description automatically populated that there was a custom deck, and there's no deck on the house, but it was picking and choosing these types of, words and terms and trying to put them together in a description, and it was wrong. So I think, we've got a long way to go, but certainly within the next 3 to 5 years could eliminate a lot of jobs.
So there are so many people on the sidelines waiting for quote unquote signs on when the market is really shifting. One of our viewers made a comment, saw my first rent to own sign, positive sight, the market is changing.
I'm not so sure that I would say that is a positive sign. I mean, rent to own is certainly nothing new. It's a fancy way of saying you're a renter. Basically what happens a lot of times, these owners of the property, they'll rent it with the hopes to sell it at a later date. And then some will promise to take some of your rent and put it towards your closing costs or things like that you pay every single month. So if you were to lock in a price right now, you might think, well, geez, I'm overpaying, right? And the seller, if they were to lock in a price right now, they may say, well, I'm underselling it because if I sell it 5 years from now, why would I lock it in? But I think the biggest thing, and look, we had a caller, actually it was our live caller that came in, he had mentioned that they were going to buy the house that they were in. I think, they've been there for 12 years. And he was saying, hey, we were going to buy that, but the landlord, something changed or whatever. So very rarely have I seen a rent to own workout. But I will say that I have seen tenants buy the house, but they didn't have any rent to own in place. They just later said, hey, we'd like to buy this place. Or the seller came to them and said, hey, we want to sell. Are you interested in buying? I've seen that work. I've rarely seen a rent to own actually happen.
So as we are aware, next year, 2024, is a election year. Some of our viewers even had speculation that there may be another stimulus as we approach the presidential election. We had a viewer ask a question. How will the 2024 presidential election manipulate market mechanisms?
And we try and keep politics off of our channel because, you can't, you just can't make people happy when you do this. People are just so divided right now. They either want one side or the other, and they hate the other, it seems like, It's sad, really, because in business, we have to work together, right? No matter whether we agree with people or not. I think that no matter whose side you're on, you're going to see a lot of slinging of crap, right? It's just about to fire up, to start up. But regardless of whether you're on the side of the Democrats or the Republicans, you can't deny the fact that we are in a real slump as far as our economy goes. And we judge that based on debt. We judge that based on consumer debt. We judge that based on wage growth. We judge that based on how much people have in their pockets or their ability to save, right? But most people, they cause a lot of their own problems. So I'm not making excuses or suggesting that we need a bailout. But what I am saying is that, yes, we probably will see the current administration doing everything they can to hold on to their position. But I don't know if it's going to work. I don't know how it can unless they were to print more money. I think we're in a situation, Powell just addressed, the press, the public after the last FOMC meeting, Melissa, and, it's a fact that we've added another $300 billion to our balance sheet, and we've opened up $4 trillion for banks to be bailed out, to get money and loans for operational purposes and to, pay depositors cash that the banks don't have because they've invested 90% or thereabouts of the depositors' money. So when depositors go into the bank to get their money, they can't fulfill it massive scale. They just, so they need to be bailed out like we've seen. But I think the biggest kind of disheartening situation is that the Fed was working on, reducing its balance sheet, mortgage-backed securities, and appeared to be doing a halfway decent job of that until recently. And with adding another $300 billion back in, some of the experts and economists have said we've given up half of the progress that we've made since, I think, June of last year. So, I don't really know how, we're going to see much change unless we go back and fire up the machines. In fact, I think we're doing it now, and print money.
So there you have it, guys. Thank you so much for sending in your comments and questions. We are happy to read them and respond.
And we always say, if you like the video, you can let Melissa and I know that you did by hitting that thumbs up. And don't keep this information all to yourself. Share it with your loved ones and your friends. The share button is below. And as always, we appreciate it. If you haven't subscribed to our channel, please do so now and hit that alert bell. You'll know every time we upload content just like this. See you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.